Okay, welcome to mock exercise. And in this exercise, we're going to take a look at a question called mouse max, and we're going to deal with information regarding income statement. So how do we, what's the appropriate income statement for management as opposed to financial reporting? So the idea of reporting the income statement using the contribution margin approach or the traditional income statement approach that's used by IFRS or ASPE standards, how is that different, and which of the statements are useful for a management decision? So let's take a look at the question. So this question is a company called Mouse Max, and this company has the following traditional income statement. So this is what you've seen, a traditional income statement. You've got your revenue, you've got your cost of goods sold, and you got your selling expenses. And we're told that the income statement reflects 100,000 mice. So this reflects 100,000 units. Now, we're told that in this cost of goods sold has direct material. So I just want to write this down here. I'm going to use short form. Direct materials DM at $5 per unit. Direct labor is $1 per unit, and the unit is per mouse. And sales commission, which is part of SG&A, isn't it? Selling, general, and admin expenses, is $1.50 per unit. Now we're told that this is probably part of the cost of goods sold. So I'm going to put that S of G. Okay? This is probably part of the cost of goods sold, and this sales commission is probably part of the sales and administration. Advertising totaling $200,000. All manufacturing overhead costs are fixed. Okay, so what they asked us to do first is to develop a variable cost income statement. Okay, so what is that? What is a variable cost income statement? So that's the first thing we need to figure out what that means. Second, it says, why do traditional income statement have to conform with IFRS or ASPE? And part C, we're going to come back to it once we've done part A and B. So let's get started. So first of all, the first thing we need to do is we need to do a variable income statement, we need to segregate our cost between variable and fixed. So we need to segregate our cost between variable and fixed. Now, why is that? So first of all, let's take a look at what is variable and what is fixed. And why do we need that? We need an income statement that can segregate variable and fixed so that it allows us to predict future cost by knowing how they behave. So that's the key. It's by knowing how they behave is the reason why the variable income statement is extremely important. So let's determine what is variable, what is fixed. So we know that variable and fixed, I'm going to use the cell phone as an example. So most of us have cell phones, and you'll see that the cost of having a cell phone is what I call fixed. That means regardless whether I use it, I play with it, I get a phone call, somebody calls me, I have to pay a fixed charge to the phone provider. But as soon as I start dialing and using the long distance, then they're going to charge me per minute. So that's based on usage. So my cell phone has a combination of fixed and variable cost. So fixed cost is the basic monthly phone bill that I get, and it doesn't matter how many calls I receive or make, the cost of that will be flat, will be the same regardless of the number of calls. But with long distance, you'll see that if I don't call, I don't have any costs, but as soon as I make multiple calls, long distance calls, I start to incur cost. So variable cost, total variable cost is going to change as activity level changes. So the more I produce, the more variable costs I'm going to incur. But the variable cost per unit remains the same. It's a very important concept because variable cost is meant to be that if I don't spend, if I don't produce, I don't incur any of these costs. So if I don't call long distance, I don't incur any long distance cost. Fixed costs, on the other hand, the total fixed cost remains the same irrespective of whether I make 1 call or 2 calls or 100 calls. So another example of the telephone bill would be things like amortization and insurance. So the total fixed cost remains the same, but because we base it on the number of activities or units, the average fixed cost per unit actually goes up or down depending on activity. So that's the difference between the two. Now, when you look at my cell phone bill, why do I care? Well, I need to know what components are fixed and variable, so it allows me to predict my future cost. Now, most of our costs are what we call mixed cost. And mixed cost is basically adding those two, and it has a component of fixed and variable to consider. And this mixed cost can be depicted by this chart, which shows that this is the fixed level of utility charge, whether or not I use, okay? And the more, so for example, if I had a warehouse, and my warehouse also requires me to have, let's say, keeping the lights on, keeping the heat on, irrespective of whether I actually produce any units, there's a certain level of fixed cost, but then there's also that element of variable cost. The more I produce, the higher total cost I incur. Now, just a couple of things. You'll see that I've got an equation y equals a plus bx, and that is the equation that represents the mixed cost. Y represents total cost, A represents total fixed cost, and B represents the variable cost per unit, with X being the level of activity. So we're going to come back to this mixed cost a bit later in other mock exercises, but just to let you guys know the difference between the two. So when the question asks us to create a variable income statement, it means that we have to be able to segregate variable and fixed cost. Why? Because we need to know how to predict future cost, right? So we need to know how costs behave for us to be able to predict future cost. So let's take a look at the cost of goods sold. So we know that the cost of goods sold was 1,220,000. We know that the variable cost component one is direct material. We're told that direct material is part of goods sold, cost of the goods sold. That's $5. And remember, we had how many activities? We had 100,000 units. So that gives us 500,000. So of that 1.2 million, $500,000 direct material. And it says that the direct labor is $1 per mouse. Now we're going to assume direct labor is variable cost. And it kind of makes sense. But if your labor happens to be salaried employee, this is important. If you have an hourly employee workforce, then clearly if there's no work, then we send them home and we don't have to pay for them. But if you have a salaried individual and you only made 5 units today, but 50 units tomorrow and 2 units the day before, then obviously they're more like fixed because we got to pay these folks irrespective of whether there's any activities. So again, you could make the assumption that direct labor is fixed or variable. But the question will be clear, but this question wasn't clear. So we're going to attack it in 2 different ways. So this one is 100,000. Okay? And then we're told that the rest of the, so it says direct material, direct labor, and we're told that all other manufacturing costs are fixed. Okay, so all manufacturing costs are fixed. This is 600 from the 1.2. That gives us 620,000. This must be the fixed manufacturing overhead. I'm going to call that FMOH, probably for short. Okay? Now, SG&A, selling, general, and administration, is 1.150. Okay, we're told that there was advertising totaling 200,000. And what else are we told? We're told that the sales commission is $1.50. $1.50 times 100,000 units. So we know that of this 1.150, 150 of that is variable. That means that if this is fixed, then that means that 800,000 of the difference must be fixed as well. Fixed SG&A. So my total, therefore my total fixed cost is $1 million. So I needed to analyze the individual components of this. So I need to go fixed or variable, fixed or variable. I needed to kind of segregate those two to be able to prepare a variable cost income statement. So let's do that now. So let's do a variable cost income statement. Now I'm going to assume that direct labor is all variable. So if we make the assumption that they're all hourly employee and we can let them go if we don't have any work, then they're all variable cost. Starting with revenue, now, instead of cost of goods sold, what the variable income statement is, we're going to list all variable cost. The word all means it includes not just manufacturing, but it also includes selling and administration. So the first one is direct material. That one we know was 100,000 times $5. Direct labor, again, we're going to assume that's all variable. And variable SG&A, and we know that to be the sales commission, right? So we know that that's the variable amount here. Right, that's the variable amount, the 150, okay? And that's 750. So 750 here. The difference between the two is what we call a contribution margin. Okay, a contribution margin. So when we're dealing with a variable income statement, what we're asking you to do is prepare a contribution margin style income statement. Fixed cost is, we know that manufacturing overhead fixed cost was 620. We did that calculation here. And SG&A, we know the fixed cost is $1 million from a previous schedule. Operating income is 130. Now, notice that we haven't really changed the income. The income's still the same, but we're showing it differently. It's called a contribution margin format. So, in trying to answer part B to the question, it says that when you're trying to compare the traditional and the contribution margin format, what this allows us to do is to say, okay, the way we have to prepare the statements or financial statement reporting is governed by our standards of external reporting called IFRS or ASPE in Canada. And you'll see that we've got to look at it from a point of view of gross margin. How much did we sell for, and what was the cost of the goods sold? And the cost of goods sold is a combination of both variable and fixed, but related to the actual goods manufactured, the cost of the goods that it costs us to manufacture. And then we subtract all our operating expenses, which includes both fixed and variable. So this includes, so I'm going to write a little bit of note here. This includes fixed and variable. And this includes fixed and variable. Now, what the contribution margin, and contribution margin is an income statement that is redone based on how costs behave. Why is that important? Because if we know that fixed cost remains the same, but variable cost changes with quantity, we can better predict what our total profit looks like based on how many units we plan to sell or how many units we have to sell to at least break even within our profit. So it allows us that flexibility and that assessment. So in looking at the contribution margin, you'll see that we've got sales. The variable expense will include both the cost of goods sold variable and the operating expenses, and the fixed cost will be, again, the combination of both. So you'll see that I needed to pick up the F's to put it all in here to give us the same operating income. Now, when you prepare a contribution margin format income statement, it's imperative that we break it out based on a per unit. And the reason why we want to know that is because we can then make an assessment that says, if somebody comes in and says, I have an extra 10,000 units of sales, we'll know exactly that those 10,000 units is going to generate a profit of 10,000 times $20 per unit, or $200,000 profit impact to the business. Notice that it doesn't include fixed, because we're going to assume that over that relevant range of activity, that increase in 10,000 units is not going to affect the overall fixed cost. Okay? So there is extremely powerful statement. It's called the variable income statement, or we call it now the contribution margin income statement. Okay? That's what it's called. Now, we could assume that the direct labor is not fixed, and we can do that. And all we would need to do is move that down to here. That changes the contribution margin, but that just decreases this. That increases this, and that decreases, that increases this, and that increases the fixed cost, resulting in the same profit margin. Okay? Now, let's look at part C to the question. Part C says, managers sometimes divide cost of goods sold, so they will do the 1220, okay, into the number of units sold, and they will say the average cost per unit is $122 per unit. So this is part C. So that's what they'll say. They'll say part of it, so then they multiply it by the number of units, estimated future production units. Okay? Why is this method likely to produce poor quality estimate? So that's the question, isn't it? And that's a really interesting question, and it's a good one because what we've done is we know that this cost of goods sold has both fixed and variable. We know that fixed cost doesn't change. We saw that in our simple illustration of a cell phone. It doesn't change based on the number of units that you produce. So by that virtue, by using this, it's going to give us the wrong predicted profit or cost number because we will assume that the fix will change, the cost of fix, which is part of that 122, is going to change based on the number of activities. Okay, thank you.